I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, where every conversation is built around one idea. Your money is a tool to design and live your version of a rich life. Now, here's a pattern I see constantly with high earners. You've worked hard, you've saved, you've built a real balance sheet, but you've never really stopped to ask, what is it all specifically for? Not a generic retirement number, what you actually want your money to do for your life and when. Without that answer, you end up with a portfolio optimized for accumulation that doesn't know how to serve you when it matters most. Today, I'm joined by Gary Preisser, founder of Stonebriar Wealth Advisors and author of the Differentiators of Wealth. He's spent over 15 years applying a business CFO mindset to personal finance. We're getting into why purpose has to come before portfolio design, why most investors are unknowingly paying their advisors to underperform, and why asset location might be one of the simplest high impact moves you're not making. Before we get into it, make sure you're subscribed on your favorite platform. And if the show is adding value, I'd really appreciate a quick review. It goes a long way. Thanks and enjoy the episode.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. Gary, thanks for joining the Making Sense of Your Money podcast. Excited to chat with you today.
Thanks so much for having me, Dan.
Yeah, this is going to be fun. So I always like to start out by having our guests share a little bit of their background and what's led them to where they're at today. And I think you have an interesting background. We talk to a lot of folks that are in sort of the personal finance space, but you've got an interesting background. So if you don't mind, share that with our audience really quick and give us your story.
Yeah, I actually first started in the accounting world doing tax preparation. That taught me a lot about how people looked at their money. See people that were excited about a $10,000 tax refund instead of realizing that they have been loaning that money interest-free to the government for a year. So it showed me the disconnect between
Interest-free loans to the IRS. I say it all the time.
That's right. So that it showed me that there's a disconnect between our understanding of money. And then I got into small business consulting and really got to a sense of how much better information can make a difference in decisions, financial decisions for small business owners. And then I've been, when I came to personal finance about 15, 17 years ago, I realized that those same concepts that I had learned and applied for small businesses were not being applied for individuals, at least on the investment side. And so when I look at things a little bit differently, especially from a cash flow and standpoint, similar to how I looked at small businesses.
Yeah, that's very cool because we typically every sustainable, profitable business has a CFO or a controller or at least an accountant that's helping them to guide financial decisions. But
Yes,
not all families implement that same methodology. So I'm intrigued by this concept. So maybe tell us a little bit about what you learned in the business side that you now apply to the personal side, especially around cash flow.
well, every financial decision that we make is based on cash flow, where we live, where we work, what we eat, where we vacation, where our kids go to school. Everything is based on cash flow. And then when I got into this portion of the industry, you get a risk questionnaire slid across the table to the investor that asks them how they feel. And I'm like, feelings don't really matter and feelings change. And also feelings should not be applied to every portion of the portfolio. So those questions, first of all, no one can understand them. And when we take the answers or jump to conclusions based on that, and then apply basically maybe 5 categories to every family in the country, much less the world, how is that individualized? It's about scale and it's about standardization. And it really doesn't need to be that way, because what's unique about each of us is our own cash flow, the timing of when we need the money. And that timing is determined by our purpose. And it's fascinating to me that our industry focuses at first on products and allocations instead of first just asking, what's the money for? Once we know what the money's for, then we know when it's going to be used. And if we know when it's going to be used, then we know what it should be invested in. If you tell me you need $25,000 in 6 months for a family vacation or for a car or whatever it is, I'm not going to put that in Bitcoin, first of all. I'm not going to put it in the market because it's the volatility, but I'm also not going to put it in a 12-month CD. There may not be volatility, there may not be risk, quote unquote, but it's not liquid, it's not available. So we need to focus. I want to focus. This is important for small businesses, but it's important for individuals as well. What's the function of each dollar? Not
Yeah, I think it's fascinating being a small business owner myself now, and then seeing a lot of these various different financial and wealth plans. There are a lot of similarities that you can make, and businesses need to be acutely and really, really focused on cash flow, right? Because it's all
yes.
about like managing the dollars that are coming in versus the dollars going out. And I think families don't often think about it that way, but it really is the exact same concept. So let's unpack that a little bit more because you and I agree on this that you know portfolio design needs to be around purpose, and then purpose is essentially backs into what the cash flow needs are. Why don't you
Yep.
give us like some examples? Like give us some examples of the types of clients that you work with and how you help them to understand what their purpose is and then ultimately how that sort of flows to cash flow and then ultimately leads to portfolio design.
It's a great question. And I'm chuckling to myself because I'm remembering conversations that I have constantly with my clients. Most of my clients are either retirees or on the verge of retirement, and they have saved their entire life. They look up to the ants from Aesop's fables that saved the food for the winter, right? They've been saving for the future. And a big part of what I do is actually remind them that at the end of that story, the ants didn't just admire the food, they ate the food. The whole point of having that food was for it to be used for a purpose. And assets are not trophies. Look what I have. They're tools. And their only value is in how they are being utilized. And for a lot of my clients, they are shifting from accumulation only to that distribution phase. And it's almost like they need permission to do that. I give my client Frank a hard time because he will come in and brag to me about how much he saved every month. I'm like, Frank, you're 94 years old. What are you saving for? We don't realize that we're here. And when the focus, like our industry focuses on accumulation, if that's the only focus, then we never get to enough. It's always about more, more, more instead of, okay, what's actually at creating function for our lives? What's adding value? And I think a lot of, especially these baby boomers, are going to end up leaving a bunch of money to the next generation without really utilizing it for anything that added value to them.
Yeah, I see so much of a similar mindset. I think this is really pervasive across the investor community. And I think it's probably very, very specific to maybe not specific to baby boomers, but a lot of that like rhetoric comes from baby boomers. They were
Sure.
taught to accumulate, save, accumulate, save, accumulate, save. But to your point, one of my earliest mentors gave me this line. What is investing in a nutshell, right? Well, investing is you're choosing to put money aside to spend tomorrow, right? Like you're saving to
Yes.
spend tomorrow. But that mindset shift of going from accumulation to decumulation is a challenging one. So how do you help your clients to kind of think about that, unpack that, and then like feel secure and stable enough within their plan that they can actually go do it and hopefully enjoy it?
That is the trick because
Right.
it's not easy. It's a mindset shift and it takes time to give them that sense of comfort. And I appreciate what your mentor taught you. This is something I remind my clients of. Every dollar that you have is going to be spent at some point in time by somebody.
Right.
And it might as well be you because it's your money. You used it. And whether that's taking your kids on vacation now or doing things for the grandkids, whatever that is, you don't have to just, I'm not saying to just throw it away at buying from Amazon, but we want to figure out what is the purpose for each dollar. And that allows us to create design a structure, not just have a default structure, not a 60-40 stock bond split portfolio or a target fund or whatever these generic conservative, moderately conservative portfolios are, but create a structure that gives them that peace of mind and allows them to have the right behavior. Because the biggest problem that I see with clients that have that uncertainty, and especially if they're in that 60-40 typical portfolio, they may be pulling money from the bond portion of that portfolio. But what happens as soon as they pull income, which we want them to do because they're in retirement? Well, the portfolio gets rebalanced. So now those large cap growth stocks are being sold. Now, if the market's up 10%, that's fine. That might be a good thing to do. But if the market just dropped 30, that's the worst thing that could possibly happen. But it's happening automatically across trillions of dollars, probably. And so by creating a different structure where we give specific assignments and specific roles to each dollar, then we can choose an investment that meets that need and at least helps our clients shift that mindset to where they feel comfortable using their money.
Yeah, all right, that's great. That's a really good explanation around sort of that like transition into drawing off of your investments and how you properly structure that. A lot of our listeners are high earners who are really good at sort of optimizing their career, optimizing their income, but may not be as intentional about like designing their actual life around their income and finances. So, what do you see that goes wrong with that group, and how do you help folks to think about? Our term is, and I think you and I are saying a lot of the same things. We say we want to help you to design and live your version of a rich life, right? It's all about
Yes.
taking your financial tools and resources and optimizing that for the life you desire. How do you get people to think about that, and then how do you sort of build and design the plan around?
Again, it's a difficult question because those that are high earners, high achievers, it's fascinating to me. They spend so much time and effort to earn their money, earn their assets, but they haven't been taught and they haven't taken the time to learn how to make those assets work for them. There's some very simple issues or very obvious issues when it comes to that. One is taxes. Okay. Taxes affect us in every single way possible. And one of the issues with taxes, or one of the biggest issues I see with taxes, is that we are not intentional about them. The timing of tax is very important. When we pay tax determines how much tax we pay. If we're showing $1 million of income over 1 year, we're going to pay a lot more in taxes than if we spread it out over 10 years, right? So timing is important, and we can and must be intentional about when we pay tax. If we're in a higher tax bracket now, we want to defer tax. If we're going to be in a lower in the future, then we want to pay tax at that time. But for some people, that's reversed. We need to understand that. The other thing is the concept of alpha when it comes to investments. And a lot of your listeners, they're very successful in their business and in their personal lives. They expect the best from themselves and from others. And yet when you get into investments that consistently underperform the S&P 500 relative to risk, right? And this is what alpha measures. We see so many portfolios. I've analyzed thousands of portfolios. I could probably count on one hand the number that consistently have positive alpha, that consistently outperform. So they're paying their advisors to underperform the benchmark year over year, and then they don't have a target. If you aim at nothing, you will hit it. There's no purpose to it. It's just accumulation. And so there's no real satisfaction. There's no end point. There's no sense of accomplishment. It's just more, more, more. And I see them work themselves to death in pursuit of that.
All right. You said a lot of interesting things there, so I want to unpack a couple of them. First off, let's cover this topic that I think is sort of can be sort of a lightning bolt topic for many investors, which is I'm paying my advisor to outperform the S&P 500. Let's unpack that one a little bit.
Yes.
How do you help folks to think about return expectations, and then what are like of course it's unique, of course it's different, of course it's customized to each individual, each family,
Yes.
but what are some of the principles that your firm deploys to ensure that they're not paying you to underperform the S&P 500?
Great question. Our industry focuses so much on average rates of return,
Right?
which is ridiculous. And we look at managing portfolios over a duration of time, but life is not lived over a duration of time. It's lived in moments. There are moments when those dollars will be needed. And so one of the first things that we do is we assign volatility in the right place. Volatility and risk are not the same thing. I think our industry likes to kind of conflate those as if they're the same. Volatility is movement in the market, and that is, for the most part, good over a long periods of time. But when volatility meets cash flow needs and those collide, that's where we have risk. So for money that we know our clients are going to use in the next 5 or even 10 years, we take volatility out of the picture completely. Volatility only comes into play for money that they're not going to touch for 10 years. That means our clients never have to sell out of desperation just to meet a cash flow need. So that gives us the time that volatility needs to perform. But to your point, that doesn't mean that it will necessarily perform. And that's our job, is to add value. If you have an average rate of return, if I told most people, if I gave you a 7% rate of return, would you be happy with that? Most people would say, I'd be thrilled, because my other advisor gave me a Monte Carlo simulation and it told me if I have 7%, then that's good. And that doesn't tell us the whole story, obviously. But if I told you that the market was up 30 and I gave you 7, should you be happy? And of course, with that context, people realize that that's not a good outcome. Now, we have to understand volatility. Beta tells us, are we taking more risk than the market, more volatility than the market, less volatility? If the market's up 10 and we're taking half the volatility, then a 7 is actually a great number, because we should have expected to only get 5. If we got 7, we outperformed by 2. But if we're taking the same amount of volatility as the market and we get 7, then we've actually underperformed by 3 if the market was up 10. Now, for us, first of all, we assign volatility in the right place. And then in the volatility zone, as we call it, we are choosing investments, mostly individual stocks, and managing those within the universe of the S&P 500. We're not going out for penny stocks. We're measuring our performance based on the S&P. That should be our starting point. But just because we're in the S&P, we don't want to be in all of the S&P. Because as you know, most of the growth is from a few of the stocks. The rest are just dragging the portfolio down. So by limiting the universe that we're choosing from helps immensely. The other thing is, by choosing individual stocks, a lot of people think that that's too risky, more
Right.
risky. But the best example of this was about a year ago. We had individual stocks, basically the top 50 of the S&P. Let's use that as an example. The tariffs brought all the values down. The market starts to rebound, but there was one stock in particular that was going in the wrong direction. It had dropped 10% when the market was rebounding. We were able to say, let's get out of that stock instead of getting out of the entire S&P 500. And that was United Healthcare, that ended up dropping another 45%. So that's a way to add value. And we can only really do that if we're being very specific. And we find, from a diversification standpoint, well, you can't just buy one stock, which I appreciate. So you have a mutual fund, which has lots of stocks. And then you can't just have one mutual fund. So you have lots of mutual funds. And now they all own the same stocks in a bunch of different places.
So you're just duplicating there's no
You're
diversification.
duplicating it.
Right.
And when you want to get out of United Healthcare, the only way to do it is to sell out of everything. And that is, it looks like it's diversified. It looks like it's providing risk management, and it's not. So by changing the narrative and changing the structure, we're able to provide alpha consistently.
Yeah, that makes a lot of sense. I actually wrote a LinkedIn post on this concept yesterday, which is all about, sort of masking diversification. And you've got all these different wrappers out there today that mask diversification. And the reality is, over 40% of the S&P 500 is concentrated in 10 or less companies on a given day, right? So we're even seeing that the S&P 500 today isn't very diversified. So it's an interesting dynamic that investors have to navigate. All right. So that all makes sense, right? Define your purpose, understand when you need the cash, divine build portfolios around that structure and around that cash flow need. Let's go to the beginning of the process.
Okay.
What about when a client doesn't really know what their purpose is and what they want to achieve and what they want to accomplish? I see it all the time. So how do you sort of work with someone that doesn't really have a great answer for that question. And maybe they've just been taught, as we mentioned before, accumulate, 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 accumulate. And they've never really thought about what they want to do with their money.
I think that's the trick, because it has to start with asking the right questions. When early in my career, I get prospects that say, well, what if I gave you $500,000 to manage? Where would you put it? And initially, I would try to answer that question, right?
Yeah.
Which was a terrible idea.
Right. Don't even answer it. Yeah.
The only way to answer that question is by asking a question in return. And that is, what is the money for? And now it puts it back on them, because to your point, they've never thought about it other than to grow. And that may be the purpose for that portion of the portfolio, but it's certainly not the purpose for the entire portfolio. And so it takes time. I think this is why our industry has gravitated away from asking these questions. Because again, if we're trying to work at scale, it's a lot easier to say, oh, well, you look like you're 65 and conservative. Here's a portfolio. And really, it's fascinating to me. Our industry says, trust us with your money, but don't pay attention to what we're doing behind the curtain, because this is too complicated for you, which is not true. And when the market's up, look what I did for you, even though I underperformed the benchmark. And when the market's down, well, that's not my fault the market's down. We can and we should be more individual, more specific with our clients by asking those questions up front. What is the purpose? And you're right, they don't have the answer for that because they haven't thought about it in these terms. It takes a while to get to that point, but we can't just give up and say, oh, well, I guess they're not going to get it. We need to be persistent in helping them understand the purpose, because that's the only way that they're going to find success. Otherwise, it's just that hamster wheel. It's always more and more and more, and never feeling secure. I'm sure you've seen people with millions of dollars in their portfolio, but they're living paycheck to paycheck and they don't feel secure in spending any of it.
100%. And what you just articulated is why I very much believe that any type of personal finance relationship needs to be built around a foundation of a long-term partnership, right? It can't be a transactional experience. It can't be just a one-time thing, because a lot of people are searching for just the quick advice, the quick plan, the quick portfolio pick, or whatever the case may be. The reality of it is, that advice in a vacuum in a one-time point in time can be very dangerous, frankly, versus sort of a long-term evolving partnership. So we're certainly aligned on that. All right, so let's shift gears a little bit, Gary. Tell us a little bit about what's your version of a rich life. You talked about helping your clients figure that out. What does that look like for you today? And maybe how has that evolved over time?
It's really about adding value to those around me. And that's just been kind of the nature of who I am. I'm the oldest of 6 kids. One of my brothers, in particular, my second brother, the story goes that he didn't speak for 2.5 years because I always spoke for him. Greg is hungry. Greg is tired, because I wanted to add value to him and to his life. Now, once he started talking, he never shut up. And then I would never spoke again, because he's really good at that. He's a fighter pilot, a retired colonel in the Air Force, fighter pilot,
Nice.
very successful. Got a very successful family. I'm really proud of all of them. But it showed that it wasn't just about me. It was never about me. It was about what kind of value, what kind of an impact can I have for those around me. And originally my parents were teachers. We didn't have wealth managers. I had no idea what this was. I didn't even understand. I don't think we had a tax preparer or any kind of advisor, because we were just trying to get by, and kudos to my parents for managing to do that. When I was growing up, the only 3 professions that I thought were of any value were being a teacher, a lawyer, or a doctor. I knew teachers didn't make any money. I thought all lawyers were scumbags, because that's just what you hear, right? I know that's not the case for all you lawyers out there.
Yeah.
And then, so I'm like, oh, great, I'll be a doctor, because then I can help people. And I ended up not going down that route, but I still feel like we are able to make a big difference for our clients, add a lot of value. And I really see it similar to a doctor relationship. You talked about, you can't just go into the doctor's office and say, you know what, I'm really tired. Well, here's what you should do. The doctor should not make that recommendation just based on one symptom, right? And we shouldn't do the same thing from a financial standpoint. We need to take the time from an industry standpoint to really analyze what is their current financial situation, what is the purpose for their finances, what should it be, what do they want it to look like, and take that step by step to create a plan that not only works and functions on a day-to-day basis, but also is adjustable. I think our industry doesn't know when to make changes to the portfolio. And if you're basing it just on, well, are you still conservative? And now instead of 65, you're 66. So we're going to change it for that reason. That's not what matters. What matters is, did you have a spouse who passed away? Did you have a child who's on the verge of getting married? Do you have a grandchild that you wanted to send to Harvard? Whatever that, those cash flow needs are what should cause us to adjust the plan. And so it's critical that we measure not average rates of return, but measure alignment to our purpose. And if we can do that, then our plans are going to be functional. They're never perfect. We can't tell the future, but at least we know how to adjust them to land where we want.
Yeah, it makes a lot of sense. Makes a lot of sense. All right. So I know you, I don't know when it was, but you wrote a book around some of these concepts that you've talked about today. Tell us a little bit about the book.
So I've got a few books, but one of the most critical, I think, is called The Differentiators of Wealth. And differentiators because these are the topics that we find that most advisors don't talk about and that can make the biggest difference. We touched on them a little bit with the alpha and beta actually outperforming. If we can outperform or at least not underperform the benchmark, I see so many portfolios that underperform by 3% per year. In over 10, 20, 30 years, that's a huge number.
Big number.
One of the other big things is we talked a little bit about taxes. Does it make sense? When do we pay tax determines how much tax we pay, but it also affects our investments. The concept of asset location is a very simple concept, but most people have never heard of it.
Explain that. Most people know asset allocation. Explain
Correct.
asset location because they're very different concepts.
They're very different concepts. And so now we're taking the allocation and adding a tax aspect to it. And the simplest way I can explain it is, let's say you have a portfolio and you want half of your portfolio in a conservative investment that you're going to expect to earn 5%. And you want half of your portfolio in a more aggressive investment that you expect to earn 10. And half of your money is in a tax-deferred IRA, traditional IRA, and half your money is in a tax-free Roth IRA. Which investment do you want in each account? Which location do you want? And I think it's pretty clear that the investment you expect to earn 10%, you want to pay zero tax on that one. You are willing to pay, you would rather pay tax rather on the 5% investment. We'd rather not pay tax at all. But just in this example, if we have to choose, we want to incorporate or understand which investments we're choosing. Now, across all the investments that I've looked at or portfolios, I'm sure you've had the same experience. I have seen those two, IRA and Roth, invested exactly the same. Half in the aggressive, half in the conservative. And it's ridiculous. It causes a tax drag of could be 1.5% per year, which is a big deal. We're not changing the investments. We're not changing the risk profile in any way. We're just changing the location slightly, and it can make a huge difference. And that's why we call it the differentiators of wealth.
All right. I love it. Good explanation there. I think that was super educational. Good concept for those out there that are only thinking about, what goes into their investments, but where it's located oftentimes has a bigger impact on the after tax, return that actually hits your portfolio and someday hits your pockets. So
Absolutely.
that's a big concept for sure. All right. It's time for the lightning round, Gary. You ready?
Let me get warmed up a little bit, Dan. Yeah, I'm ready to go.
Good. Concept is super simple. First thought that comes to your mind. Could be a one-word answer. Could be a long drawn-out thought and anywhere in between. All right, let's do it.
All right.
One meal for the rest of your life. What is it?
Well, there's this basil chicken with bell peppers, like at a Burmese restaurant or a Thai restaurant. That's just amazing with some rice. I feel like I could eat that every day.
All right, I love it. What's one technology, could be a tool, could be hardware, could be software, but not your computer or your phone? Anything but your computer or your phone you can't live without.
Ooh. Well, I could probably get my car at this point.
Yeah.
Got to get back and forth and got to get to places.
There you go. That's come up a few times. Do you have a favorite quote or phrase about money or success?
The quote, or really the phrase that has stuck with me, actually came from Simon Sinek, "Start with why."
Yeah.
And I
Yeah.
never it took me a while to apply that to finances and to our but it's really the basis for everything that we do. And if you start with that, I think it gives us our best chance for success.
Yeah, start with why is a great concept. You can apply that to finance, you can apply that to your business, your career, and certainly your life, right? Like if you
Absolutely.
just and not enough people do that, just think about the why, right? Like actually just spend a little bit of time purposefully thinking about that. And I know I do, and it sounds like you do as well. I try and push our clients to do that before they start an engagement with us because, like we discussed earlier, the planning where all the technical stuff that we've talked about is only as good as what you actually want to do with it, right? So, really
That's
important.
exactly right.
Cool. What's one habit that's had a major impact on your success?
I never do my habits as well as I would like. Obviously, well, physical fitness is very important to me, and it's tough to do that, as you know, with the small business and family responsibilities. So trying to get out of the office as I sit here for hours at a time behind my
Sure.
desk, getting out, getting some sunshine, getting that blood pumping, it allows me to think of things in a different perspective. And some of my best ideas have come from going out and getting a hike in these mountains in Utah, especially, and taking advantage of that fresh air and sunshine.
Yeah, that's when a lot of the best thinking happens. That's for sure. Let's talk about your bucket list. Can you share one item that you've already checked off and one that's still on there?
One that I've checked off is, well, I finally made it to Europe this year.
Nice.
I got a chance to go to Europe. My fiance had a work trip there, and
Nice.
she had just had knee surgery, and it was at the end of January to go to Paris. So not an ideal experience for Paris, but it was still so cool to be able to see what there is to see. Go to Zurich, go into Liechtenstein. So I got that checked off my bucket list. So I don't have to go back there. One that's still on my bucket list, I think, is I hear wonderful things about Costa Rica, and I'd love to live in or stay in one of those huts on the water that have the glass bottom. So there's a couple bucket list items.
What's one belief about money that you wish people would unlearn?
That it's scarce. I think we have such a scarcity mindset, and I grew up with that, and I get it, and I understand it. And
Yep.
we've got to live with our means, and there's some basic budgeting. But beyond that, again, money's not a trophy; it's a tool. It's an opportunity. Its only value is in utilizing it. We do not want to bury that talent in the ground. We want to put it to use, put it to work, so that it adds value to our lives and to those around us.
Said. And then last one, what's one piece of advice you would give to your younger self?
Is to start with purpose. Start with that why.
Start
It
with
was
the why.
so difficult, especially early in my career. Young kids, young family, you're
Sure.
just trying to survive. And that's very important. And I get it. But the more we can step back and say, are my decisions pushing me and leading me to where I want to be from a financial standpoint, from a personal standpoint, from a spiritual standpoint, whatever that is, or is it taking it farther away? And if we can try to stay aligned in every decision that we make. There's still going to be obstacles. There's always going to be obstacles, but it will give us a better chance of becoming the people that we want to be and having the life we want to live.
Very well said. Really cool. All right. And if our listeners want to connect with you, potentially work with you or learn more about you, or maybe get your latest book, what's the best way for them to find you?
Stonebriar Wealth Advisors.com is our company website. The book is there. We have a couple of books that are free of charge in electronic format, but feel free to connect with me on LinkedIn. Gary Preisser, Preisser. It doesn't look like it's pronounced, but that's how it's spelled. I love to talk to people about these concepts. I appreciate you, Dan, and what you're doing, and would be happy to connect.
Awesome, man. Thanks for sharing. Thanks for coming on. Really great discussion. Appreciate having you.
Thank you, Dan.
All right, that's it for the episode. You can find our podcast along with our newsletter and YouTube channel all for free at makingsenseofyourmoney.com. And as always, make sure to prioritize your version of a rich life. All right.